Welcome to the CEC Report. It's the 15th of January. I'm Robert Barwick and I'm joined today by CEC leader Craig Isherwood. Welcome, Craig.
Yeah, thanks, Robbie.
In this week's CEC Report, bankers panic in crash of 2016. Keep calm and enact Glass-Steagall. And without Glass-Steagall, Australian bank deposits will be bailed in. So first, bankers panic in crash of 2016. Keep calm and enact Glass-Steagall. As of the 1st of January, Craig, we've had just turmoil in the financial markets around the world, stock markets, commodities markets, etc. And you have to say, just in the last few days, there have been some real signs that the bankers are in a complete panic about this. I'll give you two examples. In the 12th of January London Telegraph, a regular finance writer, Ambrose Evans Pritchard, reported that the Royal Bank of Scotland, which is one of Britain's biggest banks, had just advised its clients to sell everything, and its logic was that the warning signs are the same as they were in 2008. And by the way, we'll give some predicates of that in a minute. But this was the quote in a note that the Royal Bank of Scotland sent out to its clients. Quote, "Sell everything except high quality bonds. This is about return of capital, i.e. not losing your money, not return on capital, i.e. profit. In a crowded hall, exit doors are small," end quote. All right, so that's stark.
Very stark, yeah.
It's also unusual given that, there's this, the viewers will probably recognise this phenomenon where people say, you shouldn't talk down the markets, right? Bankers are the main ones to say that. When bankers are using this kind of language, you know that there's not much to talk down anymore, right? It's going down. So that was the Royal Bank of Scotland. The next day, on the 12th of January, the Telegraph then quoted a well-known analyst for Societe Generale, Albert Edwards, who was forecasting a, quote, global deflation and recession and market carnage, quote unquote, in which he's saying that the US stock market could collapse by 75%. So we're talking about, they say that the 2008 crash was the biggest one since the Great Depression. We're talking about something that would be as big, if not bigger, than the Great Depression, the 1929 market crash.
And I think you have to look at that in the context that what we've been speaking about constantly on this show, Robbie, is that there's been nothing done since 2008 with the global financial crisis. Yep. Not one thing. We have a massive international global speculative derivatives bubble. These are speculative casino type gambling, $2 quadrillion. Nothing's been done about these things, and no one wants to talk about dealing with them because that's where Glass-Steagall comes in.
Exactly. So the President of the United States, Obama, gave his State of the Union a couple of days ago, where he announced the US economy is great, unemployment's 5%, it's all good, as if there's just a no-brainer, we've had a recovery. Yet that's all words, because in reality, in terms of what actually caused the crisis then, instead of dealing with it with Glass-Steagall, which we'll talk about in a minute, they just let that kind of gambling get bigger and bigger. So now it's, like you said, over $2 quadrillion. And who should be surprised, therefore, that this is all melting down on us now?
That's right. I think the fact that the stock markets went into free fall is all part of what's taking place in Europe with these new, what we call bail-in laws, which is basically a license for bankers to steal people's deposits and their assets and so forth. And when I say a license to steal, they don't need a license to steal. They've already got that's the nature of banking these days, because what's taking place in Europe and what's being shown to take place is they don't really care about the law. They'll do whatever it takes to save the banking system.
Because the point about what you're just saying there, Craig, is that they're claiming that the purpose of bail-in is to preserve banking, when in reality there's no way it can do that. It will destroy banking by destroying customers' deposits in banking. What it will do, though, is as the whole thing crashes, the people in charge of the system will be able to steal what they need to keep their wealth for themselves, right? And the majority of people lose out completely.
Well, I think you have to look at it, Robbie. If you add up all the deposits in the world, all the stock markets, they're still only a fraction of what this derivatives bubble is. There's no way you can actually bail this thing out. without an organised Glass-Steagall, which we'll come back to in a minute.
So hold that thought. I want to give some current predicates now of this crash. So these bankers that are making these warnings, they're saying it in the context of this. The actual market collapses since the 1st of January, as of now, Craig, add up to 3.17 trillion wiped off stock markets globally since 1st of January. Now, we haven't seen losses like in that order since September, October 2008, right? So that's a pretty concrete measure. The thing is, though, I always take a slightly standoffish attitude to stock market crashes because it really is a roller coaster, and they're kind of easy to manipulate. There are more fundamental crashes. The continued collapse of the price of oil is one of the more shocking things, and there are forecasts it could go as low as $16 a barrel. Now, overnight it dropped briefly below $30 a barrel, right, which is the first time that's happened for ages. So, and that's what the forecasts are. That would be devastating for so many, not for us, though it's not coming down at the pump at the same rate it's going down on the markets, as we know. But anyway, we'll all enjoy cheap petrol. That's not the point. The point is there's so much speculation on oil, it's going to devastate it.
And I think, Rob, just to highlight that we heard this morning from EIR, is that its program of keeping the oil prices low has been a deliberate policy of particularly the Saudi government, where they can extract oil out of the ground for about $5 a barrel.
Yeah.
Whereas things like the shale oil industry, right, it costs them at least $30 to $40 a barrel to extract that oil. Now there's $5 trillion of investments and so forth that have now basically gone into junk status in the US in particular because of the collapse of the oil price.
Well, here's a predicate on that, Craig. So junk bonds, which are junk doesn't literally mean junk. It's just a slang word that the markets use for the things that are not the most secure bonds. And so when companies sell junk bonds, which is rated CCC and below, they have to make them highly profitable, right? So there's usually a higher interest rate on them. Junk bonds in the US now are returning 20%. That's what they're offering when they're selling junk bonds, and that's what they're trading at. And that's up from July 2014, they're at 9%. So that rise from 9% to 20% shows just how the risk on those bonds have increased, and like you said, a lot of that is on the investment that's gone to shale oil, which the people who invested know they're probably not going to get their money back. Another predicate is Europe's bond market has frozen up since Portugal bailed in this bank called Banco Novo, and what they did was they even broke the rules that they claimed they had for bail-in. They bailed in the bonds of this bank, and it just destroyed the confidence of the bond market in bonds, right? And the European bond market has frozen up, and that just reinforces what we say bail-in will do generally.
Yeah, the prices of the shares in that bank, which is supposed to be a new bank created to protect people's assets, went from 94 cents to something like 14 cents in the space of an hour or two.
Yeah, that's what happens when you bail in. Here's a big one. Germany's industrial production, the growth in its industrial production as of now is at 0%. Now, Germany is the engine of Europe, right? That's a very serious reflection of the state of the crisis. And of course, as you said, another predicate is bail-in itself. The fact that that's in place means that the European financial system is in deep trouble. Now, commentators blame China for this, but the reality is the slowdown in Chinese manufacturing that's being hyped up is not a Chinese problem per se. China manufactures for the West. Right, it reflects the fact that, as you said, since 2008, nothing was done in the West. It reflects the German slowdown. It reflects the fact that in America, Obama might claim there's 5% unemployment, but there's 93 million Americans of working age who have dropped out of the workforce and aren't counted as employed, right, as in the figures. That's why Chinese manufacturing is slowing. Chinese investment and its services sector is still strong. And the stock market problems in China are a very small part of its economy. So, that's not a real issue to China. The real issue is the West, and we have not solved the problem of 2008. And the reason why, and I'll get you to comment on this, is they didn't pass Glass-Steagall when 2008 proved they shouldn't have repealed it in 1999, and instead of reenacting it again straight away, as we and many others call for, they didn't do it. and that's the root of the problem now, right?
Well, that's right. We keep, for our new viewers, and we talk about Glass-Steagall, people say, what are these guys talking about? Well, we're talking about a principle here, a principle that's been enshrined in legislation both here in Australia, around the world, and particularly in the United States, where in 1933, Franklin Roosevelt had similar problems to what we've got today, rampant speculation in the banking system that collapsed the entire stock market and the entire economic system in the US in the 20s and the 30s. And what he said, no, we have to have a necessary commercial banking system that's protected to be able to make the economy function. You still have to have a monetary
the
system.
real economy,
Yeah.
and the gamblers are away from
And
it.
you have the other aspect of the banking, which is your merchant bankers and your investment bankers. And back in the 30s, they were into the derivatives of their day, but effectively it was all speculation. So what we need today, and each country needs to pass legislation in a coordinated way, what we call a global Glass-Steagall, whereby the legitimate banking, commercial banking parts of the banking system is protected, and all this other speculative stuff is got rid of. You break up the big banks.
Yeah.
No more stockbroking houses, insurance companies, merchant banking, investment banking, and
All under
commercial
one roof.
banking, all under the one roof with the one board, one big shop. What you've got to have is a commercial bank or a trading bank that is there for the purposes of running mortgages, loans, and so forth for the physical economy, and all these other aspects. Your insurance companies are separate from the merchant banking and the investment banking. They're all broken up. Separate boards.
Yep.
We're not saying you're not going to have merchant banking, investment banking. What we're saying is that aspect of banking belongs to those who want to take those higher risks. Yep. And they've got nothing to do with the protected commercial banking, where the deposits are protected, people's and pensions and money is all protected. Well, that's not protected with the investment and merchant banking. That's the fundamental difference with Glass-Steagall, and that's what we used to have in a regulated system, but it was all taken down 1999 with the repeal of Glass-Steagall, particularly in the US. But there's been a consistent deregulation of the financial system into a market-based system whereby people and their deposits are basically unprotected.
Yeah, so, and instead of Glass-Steagall, we're getting bail-in, which is the polar opposite. So let's take a break, and when we're going to come back, we're going to talk about why that's an issue for Australia now. Welcome back to the CEC Report. Without Glass-Steagall, Australian bank deposits will be bailed in. Now, Craig, we've been updating our understanding of the status of bail-in in Australia because we're sort of best qualified to do it. When we first got wind of this in 2013, after what happened in Cyprus and the devastation that caused over there, which shocked the world that all of a sudden customers could lose their savings in order to keep banks going, we started digging around, and the first thing we found out was that the Financial Stability Board at the Bank for International Settlements in Switzerland had produced a report that said bail-in legislation is in train, quote unquote, in Australia, right? And we set out to track that down, and what we got ever since from the officialdom is denials, right? But we know you can't take that at face value. Well, as it turns out, now that you've got a situation where in Europe, as of the 1st of January, bail-in is the law. It's not a case-by-case basis anymore. If a bank gets in trouble, it will be bailed in, so no banks go under.
Yeah. So, Robbie, just to clarify for our viewers, that bail-in is when a bank gets into trouble, right? The authorities come in and they basically say, okay, well, we have to reduce the liabilities of this bank in order to make it
Pretend
solvent. Pretend it's solvent. In order to do that, a liability is things like bonds, deposits, and so forth.
Deposits are liabilities, that's right.
Liabilities to a bank. So what they're going to do is, first of all, they're going to take the bonds, right, and get rid of them, write them out to zero, and then they'll start to take a portion of people's deposits. And this is not hypothetical. This is actually what took place in Cyprus in March of 2013, and it's taken place recently with Banco Espirito Santo in Portugal, and it also has taken place in Italy. So this is current practice within the banking system. And what you said before about, we get these denials from the Australian APRA in particular, that's tasked with managing financial stability of the government, oh no, this is not happening, right? Or they try to denial it. Even Joe Hockey, the former Treasurer, wanted to denial this is not happening. But the fact is that it is in fact in place here in Australia.
Well, what we're going to demonstrate now is the fact that Australia is part of the global financial system means that whatever our government wants to pretend, we are going to have to do this, right? That's the way this global financial system currently works. So I'll give you the predicates. And what was most interesting is that the Financial Review has some reporters that are looking at this closely, because as it turns out, coming up to the January 1st deadline for this to be law in Europe and other things coming out of Basel, Australia's banks have been paying attention to this question, and so the Financial Review reporting was reflecting the concern that's rising in Australia's banks. And Christopher Joy, who's a banker who writes for the Financial Review, he wrote a very interesting column on the 20th of December where he basically said APRA should admit that it can bail in bondholders. Now, the fact that he's saying that, and here's, I'll just read the quote quickly. The nub of the challenge for APRA is whether it is prepared to more publicly acknowledge that all bank-issued liabilities, brackets, except for deposits, including senior and subordinated bonds, can be forced to wear losses under Australia's law. So not only is he saying that that's the case already, he's also pointing out that APRA denies this, right? So he's confirming something we found, that these authorities aren't honest when it comes to these issues because they're scared of the implications of people losing confidence in the system. So that was quite something. And then he had other bankers who were backing him up, and one banker that he quoted on it said, quote, "There is absolutely no doubt that the major banks' senior bonds can suffer losses under the Banking Act, and investors would be naive if they thought otherwise," says a banker who requested anonymity given the sensitivity of the subject matter. So that's the way the banking system operates here. They keep things under wraps until they have to use it. So here's the point he's making. Every other jurisdiction in the world comparable to Australia can do this. Don't pretend it can't be done here. And therefore, Craig, we're saying the same thing about depositors, right? Because every other comparable jurisdiction in the world to Australia, the EU and UK, including the UK, the United States, Canada and New Zealand emphatically, all can and plan to bail in depositors. And little old Australia is saying, our government's saying, and APRA is saying, oh, we're not going to bail in depositors here, right? There's no way that can be true. And after the break, we'll prove it. Welcome back to the CEC Report, where we're discussing, without Glass-Steagall, Australian bank deposits will be bailed in. So we said before the break, we will now prove that bank deposits will be bailed in Australia. And the proof is derivatives, right? These toxic gambling instruments that should be illegal up until like 89 and 90 under German law. They were illegal under the same law that banned gambling, right? They should be illegal. You said at the start of the show there's $2 quadrillion that this bubble has reached the size of now, right? And that is why Australian banks deposits will be bailed in. How does it work? Bail-in has one priority: financial stability. The Financial Stability Board and the Bank for International Settlements in Basel, who cooked it up, and the G20 who've signed on it after 2008, what they said was, here's a bank, Lehman Brothers, went under, and it triggered this chain reaction in the system because of its derivatives obligations. We cannot let that kind of chain reaction meltdown happen because that will swamp all banks. So we're going to come up with this system, bail-in, so that we can keep banks going without taxpayers bailing them out. And Australia, well, we're going to put a graph on the board that'll show, just as an example first, the United Kingdom. These are the big 6 banks for the United Kingdom. All in each case, their derivatives are much greater than their deposits and their assets. But look at the big 3. They are monstrous derivatives exposure. And in the case of Royal Bank of Scotland, it's 91 times its deposits, right? In the case of Barclays, it's 77 times. So, Craig, as you said before, you add up all the assets, all the deposits, etc. There's no way that you can really pay out these derivatives.
No, there's
right?
absolutely no way.
Now, these institutions are pretending that they're going to respect so-called deposit guarantees, right? So that, in Australia, only everyone who's got $250,000 won't be bailed in. Well, look at our. Let's put up the graph now of Australia's banks. Now, people have probably seen this before, but it's the same problem. Essentially, it's the same problem.
We couldn't update this one after 2012 because the Commonwealth Bank refused to publish its
That's right.
notional principal value of derivatives.
As we've revealed here before, in the time that the Commonwealth Bank post 2008, by the way, post 2008, Australian banks' derivatives all shot up. Australian bank profits all shot up. We were the most profitable banks in the world. It's like we're the only economy untouched by the crash, which wasn't true. All of a sudden, our derivatives gambling went off the charts. Collectively, it's now $32 trillion our banks are exposed to. But the Commonwealth Bank stopped being honest about what its derivatives actually were. Why? So that's a separate issue. There's something very important there. But collectively, back in 2011, the Financial Stability Board, the same organisation that cooked up bail-in, said that while no one single Australian bank is globally systemically important, i.e. that a crash of one bank could bring down the global system, it also said that collectively all of Australia's banks combined are globally systemically important. So Wayne Byers, who's the chairman of APRA, the Australian Prudential Regulation Authority, who used to work at this same Bank for International Settlements that came up with this scheme, he would be the guy to decide if there's a banking crisis in Australia on the back of, say, the kind of property crash that can and will happen in this country, and the signs are already starting, right, everywhere around the country, that if this starts impacting Australia's banks, then he will have to decide, well, we're going to bail these banks in. Is he going to then say, no, I'm not going to bail in depositors, when every other jurisdiction in the world intends to bail in depositors?
The role of APRA is to protect the financial stability of the system and to protect the depositor preference. But Robbie, don't be fooled by that, because it doesn't mean they're going to guarantee deposits. It's just a preference system, which means that they have to bail in bonds and so forth ahead of deposits. Now, there's one issue here which we'll talk about in another program another time, called covered bonds, which was a trick to allow banks to have their assets ahead of even deposits when it comes to any sort of bankruptcy proceedings. But the point is that depositor preference does not mean depositor guarantee. There is a so-called guarantee of deposits up to $250,000, but that's also smoke and mirrors, because there's no way, as the Financial Stability Board and the IMF have said themselves, that that can work with any of the big four. So the point is that at some point, in the terms of a major crash, there is no reason, there's no impediment for APRA not to touch deposits.
And even if there's a law change required, the way this has worked in the past is they say, oh, it's an emergency, we've got to do something.
Well, I'm not even sure that there is a law required,
well,
that's
we
the
don't
problem.
know that. We have to confirm that. We are convinced, Craig, that they will intend to go ahead and do it anyway.
Well, that's what's happening in Europe.
Retroactively.
They just, it's like, rules of the game gets thrown out. They do whatever's necessary to protect the system, because you do have this huge derivatives bubble sitting over everything, and the last thing that they want to do is trigger a global systemic implosion of the derivatives bubble. So,
whereas, just to reinforce the point, with Glass-Steagall, none of this would be necessary.
Absolutely unnecessary. It could be a completely stable system, because people could have confidence in the system. And this is where we're getting into big problems, is that now even bonds that used to be considered guaranteed and ironclad in the banking system are now, there's a doubt now whether in fact we get your money back in buying bonds. So the stability of the system is being undermined by these policies.
Yeah. And just briefly, Craig, and as we're wrapping up, the good news is for the viewers, the US election is still featuring this Glass-Steagall debate in a big way. Bernie Sanders and Martin O'Malley on the Democratic side are pushing it very hard, and it's a huge debate about it. So this has got Wall Street spooked. But that's it. We've run out of time. Thanks for tuning in to this week's CEC Report.